more people want to hold dollars, even if they're not trading with the United States, then what it does is our currency is always a little bit stronger than it should be, which means it's, we always have a little bit extra import power, but we also have a little bit less export competitiveness, all else being equal. And so it contributes to us having a structural, like 5-decade-long trade deficit, which basically means that we've kind of hollowed out our industrial base. So our ability to make cars, our ability to make precision engineering equipment, our ability to do XYZ has been heavily impaired.
Lyn Alden, a well-known macro analyst and investment strategist, has provided her perspective on the ongoing de-dollarization agenda being pursued largely by China and other BRICS nations, as well as the rest of the world. Alden provided a detailed analysis of the end of dollar supremacy and the eventual emergence of a multipolar world adventure, which will undoubtedly be supported by China, in a recent interview with the Bankless podcast. Alden stated during the interview that she does not agree with the majority of the prevalent viewpoints. Some experts have predicted that the dollar will die soon, but others have labeled those who believe this as conspiracy theorists. Alvin concurs with the views of individuals in the latter group who believe that the US and its currency are simply too big to fail. The investment strategist believes that the collapse of the dollar may not be as imminent as some in the first group believe. However, there is already sufficient proof that a multipolar world is taking shape. Alden offers a unique perspective on the subject since, in contrast to many others, he does not think that the economy will suffer from the end of the dollar's hegemony. In fact, she thinks that for some economic indicators, the less currency is used globally, the better. Alden supports the tweet with a few insightful charts, which we will discuss in more detail later in the film.
So I do think we're seeing diversification. Now, there's like two sides of this that I think are both wrong. There are people that are always calling for like the immediate end of dollar hegemony right around the corner. And if they've been doing this for 10, 15, 20 plus years. They're always early. It's always hype driven. It's, it's like, okay, 5, 10, 15, 20 years go by and it's like, no, that's not what happened. Whereas other people are basically saying, no, all that's a conspiracy theory. It's going to stay like this forever. Nothing's going to change. And I think that's obviously, it's very backward looking. It's not dynamic. I think, what we're seeing now, China has rivaled the United States in terms of economy size and some metrics. So they're way higher than us in industrial production, more skyscrapers, more electricity, bigger commodity importer. They're the largest trade partner with most countries in the world. It used to be the United States, now it's China. They're still weaker on military, and then they're way weaker on capital controls and openness, right? So most countries feel more comfortable holding U.S. assets than China. Unless you're Russia or unless you're Iran, unless you're basically outside of that Western sphere and you're looking eastward now. So I think what we're kind of trending towards is a more multipolar world where instead of the United States kind of being the only game in town, I think we're, especially with the war and the seizing of reserves, countries don't want to have all their assets, in the United States sphere. They want to diversify their assets. They want to have diversified payment systems so they can't be cut off from global trade. They don't want their assets seized. And so I think we're seeing kind of these regional poles of power where the United States is still currently the leading currency around. It's better than the euro in many ways. It's more open than the yuan. It's still the number one or number two economy. And then you have these other ones that are competing around the margins, especially if you're, culturally or economically tied to China more so than the United States. And we've also seen a rise in gold. So, from the 70s until 2008, you had a decline in gold ownership among central banks globally. And they basically shifted out of gold and more towards dollars. Ever since the 2008 financial crisis, so the bottom, central banks got down to like just under 30,000 tons in 2009. And then ever since then, it's been a V-shaped recovery. They're just increasing their gold tonnage over time. They're back up to something like 36,000 tons. And so that's kind of like, neutral ground. If a country holds gold reserves and it actually self-custodies them, they now have this like sanction-resistant asset that is, no one can print it. It's slow, but at least it's theirs, and they can over time use it if they need to. And so I think we're seeing a little bit more of a diversification where, Brazil says, I want to hold dollars, I want to hold gold, I'm willing to hold some Chinese yuan as well because they're a big trading partner. And I think you just see that a little bit more global decentralization. Yeah, it's a good question because when people talk about dollar hegemony, they implicitly assume it's a bad thing should it be lost. And they don't ask for who and why. And so basically the way that this works is that, if you go back to the Bretton Woods system, when it was all pegged to gold, the downside of the system is that in order to maintain it, the United States got emptied out of its gold reserves. We went from like 20,000 tons of gold down to like 8,000 tons until we defaulted on the system. So that was the cost of maintaining. We got a lot of advantages from it, but that was our cost. We had to basically keep outsourcing our gold in order to maintain it. And when we pivoted towards putting the treasury at the heart of the global system in the 1970s, so most currencies, the value of their currency in large part trades on how desirable it is to hold it. But another big factor is trade balances. If Japan sells way more stuff than it buys globally, there's basically more revenue flowing into Japan, and that tends to keep the value of their, all else being equal, the value of their currency, reasonably strong. And if a country starts running persistent trade deficits, usually their currency weakens, and that has a natural effect where they're able to buy less, they're able to import less, and at the same time, their ability to export gets more competitive because they're poorer, and their labor is now cheaper, and it might be more cost effective to put a factory there. Assuming they're operating socially. On the other hand, if a country has a trade surplus, usually their currency will appreciate, and that'll increase their import power and decrease their ability to export things cost effectively, and so that can actually shrink their trade deficit. Their trade surplus back down over time. So you kind of have this natural, they kind of want to keep pushing towards a neutral trade balance through currencies. Now, one thing that happens as a problem is if a country has an extra monetary premium placed on it, if more people want to hold dollars, even if they're not trading with the United States, then what it does is our currency is always a little bit stronger than it should be, which means we always have a little bit extra import power, but we also have a little bit less export competitiveness, all else being equal. And so it contributes to us having a structural, like 5-decade-long trade deficit, which basically means that we've kind of hollowed out our industrial base. So our ability to make cars, our ability to make precision engineering equipment, our ability to do X, Y, Z has been heavily impaired. Doesn't mean we can't. If some company's particularly good, they can still be in the United States. But it's just all of the headwinds are against us in that regard, and it's way more cost effective to produce electronics and all sorts of stuff in China, Taiwan, all these other countries. And it's gotten to the point where it's gone on so long where it's almost a national security issue, where we can't even, if we want to build electronics for our military, if we want to build electronics for this, if China cuts us off, we can cut them off and cause them national security issues on certain things, but they can also cut us off and cause national security things. And so we've hollowed ourselves out enough, and that's actually a downside of the system, that basically having dollar hegemony is really good for the military-industrial complex. It's really good for DC. It's really good for the banks. It's really good for it's kind of neutral to good if you work in an industry where you're not trying to export kind of lower margin things. So if you work in tech, if you work in healthcare, it's probably pretty good for you. Whereas if you are a blue collar worker, or if you want to make stuff in America and sell it abroad, it's been negative for that group, and it's kind of been negative industrial policy, pro financialization policy. So if that were to reverse, it'd be very painful at first, but then depending on how we handled it, it would also allow our economy to be more balanced again, the way it was decades ago.
What do you think of Lyn Alden's interview and her analysis of the current de-dollarization agenda? In the section below, please share your thoughts and views. If you enjoyed this video, please turn on post alerts and subscribe to the channel to receive updates on new content. Many thanks for tuning in.